This video will show a few ways to help the average person calculate how much retirement income they will earn, according to how much they save per year. It covers people who start saving at age 30, 40, and 50, and it covers annual savings of $3,000, $12,000, and $24,000. It explains how I came up with my numbers and how you can figure it out for yourself based on your own preferences. Since I don't want to waste anybody's time, I have placed a table of contents in the description below the video so that you can jump to the sections that you are interested in. For those of you who are really in a rush to get the answer, don't worry. I will start with the summary that shows how much your savings will pay out after you retire. Then I'll provide the assumptions that were used in the calculations. Afterwards, I will walk through the calculations. Then I will explain how you can set up your own version of my charts in Excel so that you can customize the numbers according to your own situation. And lastly, for those of you who are interested in seeing how your income tax savings can boost your retirement income through the use of 401k or RRSPs, I will very quickly walk through the summary calculation and spreadsheet setup for that too. I recommend that everybody watch this video in full because you might be unnecessarily paying more income tax than you think. Let's get started. Here you can see the summary. The last three columns show how much you can expect to earn during retirement if you save the amounts that are shown in the column headings every year. For example, if you save $12,000 every single year from the age of 40 to 65, your portfolio will likely generate about $24,000 of annual interest after 65. I decided to show these 9 scenarios based on my understanding of how much people tend to save. One interesting pattern I noticed is that if you begin at age 30, your annual retirement payout ends up being about 4 times what your annual input was during your career. It is double if you begin at age 40, and it ends up being approximately 1-to-1 if you begin at age 50. As with any financial forecast, it is absolutely impossible to predict the future without making several assumptions. If some of these assumptions do not apply to you, don't worry. I will show you later in the video how you can customize it to fit your own plan. So in order to make this video concise and applicable to most people, I made the following assumptions. The same amount is saved every single year. All savings are placed into the retirement savings portfolio at the end of each year. The average rate of return before the age of 65 is 5% per year, based on the notion that a pension fund is investing the money in a well-diversified portfolio. After age 65, the principal balance is not withdrawn at all. The money that is earned during retirement is only the interest that is earned from the savings. After retirement, the portfolio is switched to a lower risk setup, and this generates 4% of interest per year. Government pensions or old age assistance programs are completely excluded from this analysis. Inflation is not included at all in this video. I will now walk through the calculations for those who begin to save at the age of 30. Here we see the beginning balance is 0. The Save column shows how much money is placed into the retirement portfolio for that year. The Average Return column shows the 5% return on investment on the balance from 1 year before each row. Then the Balance column adds up the prior year balance, the current year's savings, and the current year's average return on the prior year's balance. This chart shows how beginning at 30 years of age allows compounding to occur on each year's investment's returns. By quadrupling the $3,000 annual savings to $12,000 per year, the compounding is more evident, and as expected, doubling the $12,000 to $24,000 results in a much better retirement income. For those who begin to save for their retirement at age 40, these charts are the same, except they leave out the rows for age 30 to 39. Once again, we see the beginning balance is 0. The Save column shows how much money is placed into the retirement portfolio for that year. The Average Return column shows the 5% return on investment on the balance from 1 year before each row. Then the Balance column adds up the prior year balance, the current year's savings, and the current year's average return on the prior year's balance. This chart shows how the compounding effect on each year's investment is reduced by beginning at 40 years of age. By quadrupling the $3,000 annual savings to $12,000 per year, the compounding is improved, and as expected, doubling the $12,000 to $24,000 results in a better retirement income. For those who begin to save for their retirement at age 50, these charts are the same except they leave out the rows for age 30 to 49. Again, we see the beginning balance is 0. The Save column shows how much money is placed into the retirement portfolio for that year. The Average Return column shows the 5% return on investment on the balance from 1 year before each row. Then the Balance column adds up the prior year's balance, the current year's savings, and the current year's average return on the prior year's balance. This chart shows how quadrupling the $3,000 annual savings to $12,000 per year can help with the compounding of investment returns, and that doubling the $12,000 to $24,000 results in a higher retirement income. So how can you make your own chart? For example, you might expect to earn only 4% per year during your career, and you might want to know what your investments will look like if you save $3,000 per year for the first 10 years of your career, but then you got promoted so you boosted it to $15,000 for the rest of your career. No problem, I will show you the nuts and bolts of how to set up your own customized chart step by step. First, type in the column headings as shown in this video: age, amount saved, average return, and balance. Next, type in the age you would like to begin saving at, then fill in the age for 5 rows below it. Now select your 6 age numbers and using the tiny black box on the bottom right hand corner of your selection, shown here with the arrow, click and hold your left mouse button, then drag the little black box down until you get to age 65. In the blank row between the column headings and age 30, type a 0 just below the balance in cell D3. Now in cell C1, above the average return column heading, type 5%. It is important that you include the percentage sign here. Next, type $3,000 into cells B4, B5, and B6. Just like with the age column, select these 3 cells, but this time rather than clicking and dragging downward, just double-click the little black box on the bottom right-hand corner of your cell selection. This will copy the $3,000 to all cells below, up to the last row that has an age. Now we're going to carefully type in 2 formulas, exactly as shown here. In cell C4, type equals D3 asterisk $C $1 and then press enter. The $sign lets you copy your formula as needed, and it will always multiply the balance with the constant return rate that you have in cell C1, which is currently 5%. For the second formula, we will add the previous year's balance with the current year's savings, as well as the current year's return on the prior year's balance. So in cell D4, type equals D3 plus B4 plus C4 and then press enter. Now to complete this chart setup, select cells C4 and D4. Double-click the little black box on the bottom right-hand corner of your cell selection. This will copy your formulas to all cells below, up to the last row that has an age. In a split second, your formula will automatically adjust each row as it copies downward, so that the formula always refers to the current and previous rows as intended, so that the calculations roll through the increasing balance. At this point, you can customize your chart. For example, you may want to redo the average return column so that you can type in different return rates for every year. In this case, you would replace the asterisk $C $1 with something like 0.03 for 3%, or you might input a beginning balance of $30,000 instead of 0, then input 0 into the save column for the first 7 years. There are countless ways that you can customize your retirement savings plan, and so the sky is the limit when it comes to making your chart fit your situation. And now lastly, as I mentioned in the beginning of this video, I would like to quickly show the effect of income tax savings through retirement tax shelters. Here, the retirement earnings summary has been adjusted to show the effect of each year's boost to the annual return, which was made possible by the tax shelters such as the 401k or the RRSP. Here is a comparison to the other summary that I presented earlier in this video. All of the assumptions are the same as before, as well as a few new assumptions shown in the bold text. These new assumptions are as follows. The person who saves $3,000 per year is assumed to be earning a low income, and so they are not taxable, and all the income tax pay stub deductions are returned to them in full when they receive their tax return. For this reason, no tax boost is shown for the person who saves $3,000 per year. Secondly, the person who saves $12,000 per year is assumed to have an effective tax rate of 15%. The person who saves $24,000 per year has an effective tax rate of 20%. Please note that the effective tax rate equals total income tax payable divided by total taxable income. It is also assumed that all of the income tax benefits from the retirement shelter are separated from the rest of the tax refund and invested into the same portfolio every year. The next step is to dig up your latest completed income tax forms and look up the total tax payable amount. Be sure to include all of the income taxes that were paid for federal taxes as well as the income taxes that were paid to your local jurisdiction, whether that is regional, provincial, and/or state income tax. For the purpose of this calculation, only taxes that are based on income should be included, and any other forms of tax that are not tied to income, such as value-added tax, property tax, flat taxes, etc., should be ignored. In Canada, the total tax payable is found on line 435 of the T1 General Form, or on the Notice of Assessment that the government sends out after having reviewed and assessed the tax package. This amount includes both the federal and provincial income taxes. It is important not to confuse total taxes payable with tax refund. The tax refund is just the amount that a taxpayer is getting back because their employer deducted more from their paycheck throughout the year than what ended up being calculated after the year was over. Total tax owing is the opposite of a refund. It is the extra tax that needs to be added to the paycheck deductions that were made during the year in order to have fully paid off the necessary income taxes according to the calculation on the forms. The key is to use total taxes payable. The following is a very simplified version of how this calculation looks like on the income tax forms. Total income tax payable minus income tax already deducted from paychecks equals the tax owing or the tax refund if it's less than zero. Now that you know how much total income tax you pay to all levels of government, the next step is to find your taxable income. This is the total amount for that year, which is multiplied by the tax rate for your respective tax bracket. In Canada, taxable income is found on line 250 of the T1 General Form, or it can also be found on the Notice of Assessment. The effective tax rate is a very important ratio that summarizes and indicates what portion of the taxable earnings went towards paying income tax, after all the complex inclusions, exclusions, credits, etc. are fully calculated on all of the various tax forms. Every dollar that is saved for retirement brings down the taxable income by $1, which reduces the effective tax rate. Total taxes payable divided by taxable income is equal to the effective tax rate. Everyone's tax forms are different from each other and from year to year. This is the reason why a one-size-fits-all approach will rarely maximize long-term wealth. The $3,000 per year chart has not changed from before, but if we take a look at the new $12,000 annual savings chart, there are two new columns which show the effect of the retirement tax shelter that comes through the income tax savings. The boost column multiplies each row's amount from the save column with the effective tax rate, which varies from person to person, but which is 15% in this chart. The after-tax balance column is just the summation of the balance column and the new tax boost column. Please note that the purpose of this video is only intended as a first step in encouraging savers and taxpayers to research different options that many people are not aware of. The viewer is advised to perform further research to decide on the relevance of these items for their income tax package. Due to the sensitive nature and high level of risk involved in retirement investment funds, please consult a licensed financial advisor and local tax professional for more guidance that is specific to your situation.